Governor, I now invite you to make an opening statement.
Well, thank you very much, Chair, and good morning to all the members of the committee. As the Chair already said, these hearings are an important part of the accountability process for the Reserve Bank, and my colleagues and I are pleased to be here to answer your questions. I should note actually that there's some faces here that are new to this hearing. I've brought the whole policy leadership team with me today, and I think hopefully that this will be a very positive hearing.
Thank you.
So I'm going to start with a discussion of the inflation situation and the economic outlook, and then I'll finish with an update on priorities in the payment space and also a little bit on the cash distribution issues that the industry is dealing with at the moment. So the Reserve Bank's mandate is to contribute to the welfare of the Australian people by delivering price stability and full employment. And this mandate is set out in the Reserve Bank Act 1959. The statement on the conduct of monetary policy, which is agreed between the Australian Government and the Board, that sets out how this works in practice. Specifically, we've agreed with the Government that the best way of achieving low and stable inflation is to aim for annual consumer price inflation of between 2% and 3%. Now, while all outcomes in that range are consistent with our price stability objective, the Board sets policy to return inflation to the midpoint of the target. But the agreement with the Government provides flexibility around the time frame in which we meet our inflation objective. This is because we need to balance meeting our inflation objective with our full employment objective. That's achieving the maximum level of employment that is consistent with low and stable inflation. Now, the reason I set this out is to give some context to the Board's current strategy for monetary policy. The Board's trying to bring inflation back to target in a reasonable time frame while preserving as many of the gains in the labour market that we've seen in the past few years. This is the so-called narrow path. So how are we doing? Well, since our previous appearance before this committee, there has been further progress on inflation, but it has been slow. Inflation peaked at 7.8% in the December quarter of 2022. It came down to 4.1% at the end of 2023, but since then it's only declined a further 0.3 percentage points to 3.8% in the June quarter of 2024. Underlying inflation, which abstracts from volatile components of the index, is also still elevated at 3.9% in June 2024, and this remains too high. Our current forecasts have underlying inflation by the end of this year still sitting around 3.5%. Now, what's driving this persistent inflation? A lot of it reflects inflation in services. Most of the disinflation we've seen since the peak in December 2022 has been driven by a decline in goods price inflation. Through 2022, there was very high inflation in goods prices, reflecting supply chain issues at a time of strong aggregate demand. Prices of groceries, consumer durables and new dwelling construction costs all surged. Inflation in many of these goods has since eased substantially, except for new dwelling costs, which are still increasing by around about 5% on an annual basis. Inflation in services prices, on the other hand, has remained high, running at around 5%. There's been broad-based inflation in market services, reflecting continued demand and the ability for some businesses to pass through costs. Other contributors to high inflation have been rents and insurance, reflecting conditions specific to those industries. All of this has meant that while goods price inflation has declined substantially, it hasn't been enough to offset continued high services price inflation. This situation is not unique to Australia. Most advanced economies have experienced a similar pattern of inflation: a spike in inflation owing to goods and energy prices, followed by a sharp disinflation in goods prices, but continued high services price inflation. As a result, other central banks are remaining cautious about the future path of interest rates. Some have reduced their policy rates a little, but they have been emphasising that the job is still not done and policy remains restrictive. Likewise here in Australia. We didn't increase interest rates as much as some other central banks, and we have received some criticism for that. Indeed, some commentators continue to call for further tightening in monetary policy. But as I noted earlier, we've been trying to balance bringing inflation back down over a reasonable time frame without inflicting unnecessary damage on the labour market. And the Board's judgment to date has been that policy is currently sufficiently restrictive to do that. So that brings me to the Board's most recent decision. At its meeting on the 5th and 6th of August, the Board decided to leave the cash rate unchanged at 4.35%. It recognised that while inflation has fallen substantially since its peak, it is still some way above the midpoint of the 2 to 3% target range. And I noted earlier, inflation is proving persistent. But the Board remains vigilant to upside risks to inflation and noted that policy will need to remain sufficiently restrictive until it's confident that inflation is moving sustainably towards the target range. Now, prior to our decision, the markets had brought forward their expectations of a rate cut following inflation outcomes in the United States and the June quarter CPI in Australia coming in a bit lower than had been expected. Then there was volatility in international financial markets, and that resulted in further declines in interest rate expectations. Financial markets are still pricing in a rate cut here in Australia by the end of the year. The Board's message, though, was that it's premature to be thinking about rate cuts. Inflation is still too high, and in underlying terms, it isn't expected to be back in the top of the band until the end of next year. Circumstances may change, of course, and the outlook remains uncertain. But based on what the Board knows at present, it doesn't expect it'll be in a position to cut rates in the near term. Now, I do understand that this is not what households want to hear. Those with mortgages are feeling the squeeze on their cash flows from the increase in interest rates over the past couple of years. Businesses too are facing higher borrowing costs. The alternative of higher inflation for longer is much worse. Inflation hasn't been this high for a few decades, and I think many people have forgotten how bad it is. Some younger people, in fact, will not have experienced high inflation at all. There is a reason why there's so much talk about the cost of living. High inflation hurts everyone. It reduces what people can buy with their wages, it erodes the value of savings, and it disproportionately hurts those on low or fixed incomes. This is why it's imperative we can do what we can do to ensure that inflation returns to levels at which it's in the background again. Now, that said, the economic outlook remains uncertain. The RBA published its most recent forecasts at the same time as we announced the monetary policy decision. As I noted earlier, the central forecasts are for inflation to return to the target range late in 2025. It's forecast to approach the midpoint of the target band in 2026. This is a slightly slower return to target than we were forecasting in May. It reflects a judgment that the gap between aggregate demand and supply in the economy is larger than we previously thought. So that is, even though growth in the economy has been weak, the level of demand for goods and services is still higher than the ability of the economy to sustainably produce those goods and services. Now, these are our central forecasts, and there is substantial uncertainty around them, and more so the further you go out in the forecast period. So, recognising this, we highlighted three key risks in our statement on monetary policy. First, that there'd be more excess demand in the economy at present than we've currently assessed. Secondly, that consumption growth in the future could be stronger or weaker than expected. And third, the labour market could deteriorate by more than expected. And the statement provided some scenarios to demonstrate how different paths for the economy might affect the outcomes for inflation and employment. The scenarios show that if consumption or the labour market are weaker than expected, then inflation could return to the target band more quickly and the unemployment rate could rise more sharply. And the reverse could occur if consumption and the labour market are stronger than expected. Now, these scenarios are important because we know that economic activity and inflation could be stronger or weaker than implied by our central forecast. We have big bands of errors around them. So we need to understand the implications for the economy and how monetary policy will have to respond if things turn out differently from our central forecast. So my colleague Andrew gave a considered speech on the issue of uncertainty on Monday. And the key point of that was that we know the future is uncertain and we therefore need to be humble in our forecasts. We need to be willing to learn from our errors. We need to use a diverse range of models and qualitative intelligence, as well as internal and external challenge, and to respond as the economy evolves. The board is conscious of this, hence its commitment to be driven by the data and to adjust its assessment as necessary. The board's of the view that it currently has the right balance between reducing inflation in a reasonable timeframe and maintaining the gains in the labour market. Ultimately, our full employment goal is not served by letting inflation stay above the target indefinitely. So the board will remain focused on the potential upside risks to inflation. Now, before I finish, I wanted to say a few words on the payment system and issues in the cash distribution system. So the Parliament is currently considering some important amendments to the Payment Systems Regulation Act 1998 that will enable the bank to promote safety, efficiency and competition across all players in the payments ecosystem. Once the reforms are passed, we'll undertake a comprehensive review of our retail payments regulation. This review will consider the appropriateness of our regulatory settings and principles and how to apply them to emerging players and business models. Many stakeholders would like to see progress on a range of issues, including the high cost of payments for small businesses, surcharging of consumers and competition issues related to mobile wallets. The timely passage of the reforms will allow us to consider these issues in the broader context of the RBA's expanded regulatory arrangements. The Payment System Board discussed these issues at its quarterly meeting yesterday. It also discussed a number of other issues that are important for the future of the payment system in Australia. This included a paper that's been written jointly with the Australian Treasury, providing a stocktake and roadmap on domestic research priorities relating to the concept of a central bank digital currency, and that paper will be published in September. And the board also discussed some developments in what we call least cost routing for debit cards, challenges in wholesale cash distribution, and opportunities relating to improved access and functionality for the new payments platform. So finally, I'd like to update the committee on recent developments in the cash distribution system. So while use of cash for everyday payments has declined in recent decades, it remains an important means of payment for many Australians. Cash is used as a store of wealth, particularly during periods of economic uncertainty, and it can be a useful backup for electronic methods of payment. Now, as you know, the cash distribution system came under considerable stress earlier in the year when the financial viability of the largest firm providing cash-in-transit services, that's Linfox Armaguard, their financial viability came under question. Since then, the RBA, the Australian Treasury and key participants in the cash distribution industry have been working together to strengthen business continuity arrangements, increasing the ability of the industry to respond to a significant disruption in the supply of cash. In late June, an industry support package of approximately $50 million over 12 months was agreed with Linfox Armaguard and its major banking and retail customers, and that reduces the near-term risk of a major disruption. The funding deal should provide time for industry participants, the RBA and the government to focus on formulating a longer-term model for cash distribution so that cash is available to those who need it and want to use it. Developing a more durable future cash distribution system will require broad consultation and require participants in the system to approach these issues in the public interest. So thank you for listening, and my colleagues and I look forward to answering your questions. Thank you.
Thank you very much, Governor. Before asking some questions on the state of the Australian economy and how that's affecting monetary policy, I was interested in your thoughts on some of the broader contextual trends affecting Australia. What are some of the key risks to the global outlook in your modelling and your analysis?
Sure. So I highlighted earlier that inflation, although it's coming down overseas, it is remaining persistent, and although some other countries have started to lower their interest rates in response to that, they are cautious, and they're cautious because services inflation is remaining relatively elevated. So some of the risks around that are that central banks find that things turn down more quickly than they're expecting, and that was sort of part of the reason for the volatility in financial markets a couple of weeks ago, when there was a relatively an employment number for the United States that people thought was indicating the labour market was deteriorating quite a lot, and they reacted quite heavily to it. And there was a lot more to it than that, and we can talk about that separately if you like, but that was sort of the proximate cause. So there is a risk that things turn down more quickly, and in that case, central banks may have to lower interest rates quite quickly. That's one risk. A risk that's very pertinent for us is China. The Chinese economy is still performing okay. It's meeting their target of around about 5% growth, but they still have a very big drag from the problems in their real estate sector there. And China is really important for us because of our trade relationship with China. It's our biggest trading partner, and it's very important in particular for the prices of the commodities that we export, in particular iron ore. So that is something that we're watching quite closely, because developments in China can have quite a big impact on the way our trade develops, and that therefore on our growth. So I'd say they're two of the key risks. There are, of course, a variety of risks associated with geopolitical tensions, which we don't know how it's going to turn out. I think the risks there are really going to, if they eventuate, they're going to eventuate in supply issues. So we already saw that in the big energy shocks a couple of years ago. Energy is critical there, but any supply shocks which influence inflation, again, is going to make it difficult for central banks, because typically we would like to look through supply shocks. But if they're consistent and persistent, it makes it very difficult to just completely ignore them and the potential impact they might have on an ongoing sense on inflation expectations and the level of inflation around the world. So they're probably the main things I'd highlight.